Welcome to the Digital Insurance Pint podcast. As always, I am joined by Steve Earle, CEO of Cheap Insurance, Jeff Roy, CEO of Excalibur Insurance, and Adam Mitchell, CEO of Mitchell and Whale. So today we're going to be talking about the possible impact of COVID on broker multiples, and are we potentially going to be seeing a wave of acquisitions? Right. So maybe let's first start off with a bit of background here, guys. So maybe give me a sense. I mean, obviously the numbers won't be in until sometime down the road, but give me a sense. What are you seeing in terms of the overall premium pie for insurance? We know some people are taking cars off the road. Insurers have done some negative endorsements. Customers have done some negative endorsements on the auto side. But in general, if you look at auto, property, commercial, what's happening to that overall premium pie? And maybe Jeff, I'll go with you first. What's your sense? Are we growing, shrinking in terms of overall insured premiums?
Well, I think depending on the niche, like obviously restaurants and retail, certain niches have shrunk. They went down. Some of them are closed. Coverage is reduced, and you'll see a reduction in receipts over the next 12 months. So I think that some of that pie is going down, but there's other areas like if you're, trucking for essential services are going well. If you're FedEx or you're insuring people that are delivering stuff, you've never been busier. So there's certain areas that are growing. A lot of the coverages have been reduced, so brokers have had a ton of negative endorsements, but most of that stuff has kind of filtered through. And cancellations, that's been delayed. That's kind of the great unknown. So I think you're going to see it's hard to say because there's still rate increases going through. There's cancellations. I would suggest the pie isn't shrinking, but it's not growing as much as it would be normally. That's my gut feeling. Guys, what do you think?
Yeah, I have a couple angles. So on the pie side, I think it depends where you sit. So we're growing such that we're up sort of 25% year over year, but 7% of that growth is rate increase. That is out of our control. Now, I talked to a more traditional broker, like more classically brick and mortar shop today, and I would think they're pretty well run. They're pretty on top of it, very involved, owners, decent size, and they're down 10% last month. And so,
wow, and that includes a 7-point rate increase, so they're actually down 17.
Quite possibly. And they might not even know it. I think a lot of brokers that are calling themselves flat don't realize there's a 7% tailwind inside there. So you're actually shrinking, and you're under this cover of rate increases that when that should disappear or reform or something, you might be quite uncomfortable. So yeah, I think there are some negative endorsements happening. I think as we get into this, you're going to see a lot of brokers waking up to a rude awakening saying, I'm not into this. I'm not up for this. Who's buying? I'm checking out.
Okay, interesting. Okay, Steve, what's your perspective? From an overall perspective, personal lines, commercial lines, shrinking, growing. What's your take?
Commercial lines is certainly going to take a bump. Retail, hospitality, the most astronomically fucked up marketplace in commercial lines that we've seen in 25 years right now is messing with things as well. In personal lines, no, we're growing, mostly because people were bored and shopping online. But back to what Adam was saying about, the tailwind of rate and all that, for us, I learned a long time ago, I never measure my growth by either revenue or premium. If you want to look at growth or retraction, it's PIF. Always measure yourself on PIF, because if you're going through the rate increases that we're having, like in Atlantic Canada, there's somewhere it's been habitational is 25% up. Commercial lines is 20% up. I can beat my chest all day long about my growth, but guess what? I went backwards by 5% on PIF. That's artificially inflated growth, and you need to eliminate monitoring that artificially inflated growth.
That's not a successful long-term business.
So the AI, we got AG, artificial growth.
Yeah.
Yep.
It sounds like it's fair to say that depending on what a broker's exposure is to certain areas of the marketplace, there's going to be some brokers who are under pressure. Let's get into gossip mode here. What are you guys hearing on the street? Are you hearing brokers who are looking to sell? Or are you hearing brokers who are looking to take advantage of this marketplace and buy? What are you hearing? Maybe Adam, I'll let you go first.
Yeah, I have more acquisitions on my plate than I've ever seen before. I think there's a number of people that are reaching that fed up point and tapping out and realizing they don't want to do the next round of investments to go at it. I don't even think we're at the tipping point yet. I think it's a lot like bankruptcies with restaurants and other things. Is I think the rude awakening is still coming, and you're going to see much more going into the fall and winter, even Q1. It'll be interesting times.
Cool. Steve, what's your take? What from your neck of the woods? What are you seeing?
Not a lot of acquisitions get talked about pre-acquisition in Atlantic Canada. 96% of them are already gone, just largely due to a couple of really aggressive players over the last couple decades here. So out here, you're either going to Archway, Eustis, or Canada BrokerLink, and it's gone before anybody hears about it. There's a few small books that might be out there, but I think that like Adam said, the thrown in the towel piece, there's a lot of frustrated smaller operators out there who wanted to be around for another 10 or 15 years. They might say, you know what, this is bullshit. Like, it's a really frustrating time right now for the most astute operators are scratching their heads and banging their head against the wall. It's a tough time to be a broker right now between the insurers, the marketplace. It would be a tough time without COVID right now. It'd be a frustrating time without COVID. Technologically, marketplace-wise, all those kind of things. Throw COVID at it. That's going to be the straw for a few.
Okay. All right. Thanks, Steve. Jeff, what from your corner of the province? What are you hearing? What are you seeing on the street?
Just it's already been pretty aggressive. Like, you've already seen equity money come into play. You've got the Hubs of the world. You've got NFP coming into Canada. So they've been buying some, and not small shops, but big shops. Hubs bought a pile of benefits brokers. I don't know if they made 20 or 25 acquisitions, but they've been pretty aggressive. So you've got some traditionally, you got some equity money on play. You've got Canadian Broker Network, or Canadian Broker Link, with Intact. They've been aggressively buying people. They continue. They went on the record saying, hey, we're going to continue to buy during COVID. They've been aggressive doing stuff. And you get the super regionals, which you got the Archways, the Eustis, as Steve talked about. You got Andrew agencies in Saskatchewan area. You got McDougall, and there's a few other agents in Ontario that are kind of super regional buying in certain pockets. So there just seems to be, a lot of people out there, and if stuff comes up for sale, it's still a seller's market right now. So people can expect 3.25 to 3.75, probably more closer to 3.5 times multiples, or 10 to 14 times EBITDA seems to be the talk on the street. Generally, people don't get much more than a number, but it's like fishing. The story is always higher after the sale than what maybe it is when the paint's dry. But so you've kind of got what's going to accelerate it is just as everybody said here earlier, brokers that have tried to, they're going to get 5 more years because it's been a good cash cow. Now they're worried about their cash cow eroding, CPC being affected by, potentially bad results, more fire, stuff like that, and just loss of market share. So they're watching their nest egg potentially reduce, and they don't want the headaches of trying to digitize, trying to deal in a post-COVID world and trying to adjust all this stuff. So they're ready to check out. So I think the number of books on the block will go up, but the competition is still there. So it's very challenging for brokers to pay 3.75 to 4 times multiples. So that's going to be tricky moving forward. I don't see that number dropping anytime quickly.
Okay, so that leads us right into our next point here. So, the rise of the increase in the multiples. I mean, you can trace what multiples were back to the early to late 90s in the 1 to 1.5 times up to the 3.5 to 3.75 today, and that's really a function of supply and demand. So earlier, just a second ago, we heard that supply of brokers for sale, is potentially going to go up, which in theory would push the price, the multiple down, but we still have lots of aggressive buyers, which probably has a contradictory effect here. So where do you think things are going? Where do you just
Well,
real quickly?
so if you stack up, let's say on the buying side, let's name some big buyers. You have NFP, new to the ring. You have BrokerLink, prolific. You have Hub, pretty prolific, although maybe choosy. You have now Navicord. So let's just put those guys on the bench as buyers with, let's say they all have capital. How many deals do you think would have to hit the market before you would over-satisfy even just that hunger? Right? Like if you just doubled the supply of it, can you imagine BrokerLink saying no to a deal at 3.5? I think their normal number is 3.7 or something unsolicited. Here you go.
No.
Like I don't know that capital run drills dry, because there's also the arbitrage play. I can at least speak to BrokerLink and Hub. If they buy you for 10 times earning and it goes onto their balance sheet, that same thing that they just bought is instantly worth 15 times earnings, 20 times earnings. Like if it is truly an earning portfolio, it's almost unlimited money.
Yeah.
Yeah. And if you're a Canadian BrokerLink buying a broker at 3.5 times, if they're to buy an insurance company, they're paying $1 for $1 premium, but they're getting at 60 to 65 cents in the dollar. So it's a great way to shear up distribution a lot cheaper than trying to buy another entity, right?
Absolutely.
I actually
No
see
question.
them going up. I see the multiples going up. The supply and demand, like the other thing is you have these monstrosities whose growth model for the last however many years has been through acquisition. If they look at their organic growth, they have yet to learn how to grow organically. They just don't even understand how. And they've put nothing into it for the last decade. We've got a 3-year-old brokerage that would beat Hub indefinitely forever in Atlantic Canada on being on page one, no matter how much money they put at it, because they would just they grow through acquisition. So as these, they might need to learn, but if there's fewer and fewer brokerages to buy, and that's their model, is to buy to grow, because I'm not an economist, but if there's fewer, doesn't the price go up when something that
Absolutely. As the resource gets rare, that's why gold
even
and platinum
if
and whatever
the
are
resource,
expensive.
yeah, even if the resource is not as pure, even if the gold is not as pure as it once was, it's still gold, and we need it.
So some of these entities, though, that are buying are well-run shops, and they are getting really good growth. They've got some great niches, and they're buying some great companies, and they're buying some bigger companies. The smaller brokers trying to buy, there's not many $1, $3, $5, $10 million brokers left. You're now getting into the $20, $30 million brokers of what's left. So the cost and the spend for somebody to buy is getting to be a huge number, and to amortize that over the next 10 years, if you have to do a 10-year financing, you explain to me 10 years from now, is the model we have right now going to be sufficient, or are we going to lose a chunk of our business to self-driving cars? Is there going to be new entrants? There's a bit of risk when you start projecting out 10 years now. 20 years ago, not quite as much, but there is quite a bit of uncertainty, right? So it makes it very
actually
interesting.
One that scares me is autonomous vehicles scares me more than
but
other things.
Here's an angle. Like, let's say you just keep hammering away at efficiency and better modeling, Jeff, and improving. How many taxi agencies did Uber buy? Right, they didn't buy a thing. They just stole it all. Right? And it's interesting that you can go around buying up all the taxi agencies, but if someone comes out with a better model that resonates more and gets an edge, and I don't know that there's a quantum one yet, not at that level. There's, 10, 20% numbers that are eking out some good gains, good businesses that are starting to make money. But there's a lot of things that could still change.
In these equity firms, they're getting 30% EBITDA, 35% return. Where can you get that in the stock market? But it'll be interesting when they exit and who's going to buy them. What's that going to look like? That'll be interesting, snapshotting it down the road, what next firm's going to come in to buy them. There's always one waiting there to buy it, but it'll be really interesting
IPO.
landscape. Yeah.
IPO. You go Lemonade.
IPO.
Lemonade's 33 times revenue.
Yeah.
33 times revenue. The highest valuation on any per policy insurance company in the world.
Yeah.
That's unbelievable. That's
pretty good hype. Pretty good hype.
Yeah.
Paint me pink and give me a 33 multiple.
So speaking of another macroeconomic fact here, interest rates are super low. So, paying down capital that you're going to use to finance an acquisition is, cheaper than it's ever been. What do you see that playing into these buying decisions at all?
You could have a harder access to capital too. Like the same companies that classically funded brokers, acquiring brokers, could get a little more choosy, or
yes,
during these uncertain times, want to plow their capital into shoring up their balance sheet, doing other things, getting ready for an IPO, whatever.
Yeah. That's a great point, Adam, in the sense of depending upon where you're getting your money from, and if it's from suppliers, be it insurance companies, and you're an acquirer, that might tighten up.
That's got to be 80% of acquisitions is the very flexible money that comes from vendors sitting idle capital on the side. You're putting it work for a distribution strategy in play.
Yeah. And then also the ability to flip books for overrides. If flipping books for overrides, the valuation, if insurers are less willing to do that comes into the equation too. So
flipping books is tougher now though, because there's less markets, and who's going to be left in 5 years?
That's often the math on acquiring brokerage is flipping books and how that plays in. So that might come down a bit.
Yeah. Well, it's interesting that as interest rates come down, insurers, they may actually be. It's hard to predict, but they might actually be more open to broker financing because their ability to get a return on their investments goes down because they're restricted to very, very secure investments, which usually are fairly interest rate sensitive. So when that interest rate is quite low, they've got to make their ROE on the underwriting side and potentially on the broker financing side because their investment side, shrinks even more than it has in the past few years.
Broker financing is very, very safe for insurers. So, but they have to have the access to capital too, depending,
and
they're going to deploy that, and that's behind that big veil, depending upon what your directions are from across a pond, if you're that sort of insurer, and so on, right? Like what's coming down the pipe that way.
Yeah, absolutely. Yeah, there definitely are. I mean, some of the bigger carriers, you talk about the Avivas and RSAs and so on, sometimes their decision making is not entirely based on the Canadian market. There's outside influences there for sure. All right, so we just opened the door to carrier financing. Let's expand upon that a little bit here. So from your perspective, what you hear, a lot of carriers in the past have been in the financing game, different pros and cons related to some of them. Has anybody exited the financing game? Anybody new? What's your perspective on which carriers are sort of most active in the financing game these days? And Jeff, I'll let you go first here.
I'm probably not the one to ask, but my understanding is nobody's really officially pulled out, to my knowledge. Like I think anybody will look at them, just the magnitude of how much they'll invest and the terms may have changed a bit, but I think the usual suspects, without calling people out, are approachable, but I think they're less likely to take equity positions before. Sometimes they would take an equity position to make it more palatable. I think some insurers have kind of shied away from that. And, I think it depends on the business case. Most companies are business people. If they can get 3.5% interest or 4% on a broker loan where they got an equity and they can build market share, it's better than some of their bonds and secure stuff. So it's actually good for them because they've got locked in for 5 or 10 years. Plus they have the upside of growing the book. So I think, I think most of them are so approachable that we're doing it before. Some of them we don't, on their direct arm that we're buying people, we don't see them buying quite as much, or I don't hear a lot from Johnson's anymore. They're really adequate. They're really out there doing it. Haven't heard a lot of sales from them over the last year, but.
Okay. Steve, what's your take? Have you heard much in the way of changes on that front?
No. And I would disagree with Jeff a little bit in that the equity piece might be backing off. I would say my sense is it's probably increasing. But the thing is, like, when you're talking about our insurance suppliers giving brokers money either for acquisition or giving them money, buying half or whatever it is, some insurers are really, really good at this. But then you have to look at too, what does an insurer have to lose by losing a brokerage to a deal? So insurance company A is the lead carrier in that brokerage. Insurance company B is doing a deal with them. Insurance company A might get pretty aggressive on a defensive play and come up with a deal because they don't want to lose that book because they know it's the first thing that's gone because it's going over here.
No. Are you comfortable calling out one or two carriers you think are the best at financing? Who would you call if you wanted financing?
Well, Intact by far is the best, but they're the best for a reason. And I think that if you want to remain independent someday later or do I think that once you're involved with that organization, and I'm not saying it's a good or a bad thing because a lot of people made decisions and been quite happy, that they'll never leave your organization in that sense. And that's just their business model. Aviva has a great finance department. They know what they're doing. Wawanesa has a really, really astute finance department, but it's all going to be a deal that fits within, like, every broker is unique and it's got to fit the recipe that matches what that insurer really is looking for.
Deal still about the financial or your financial statements and your relationships. Two key things.
Yeah.
Right?
Yeah. I mean, there's every deal would be entirely unique.
All right. Adam, what's your, you want to chime in on this? Who's
the only new player I've seen to the market is, well, a couple, I guess, on Unica started to lend. I think it's pretty specialty to when it makes sense to their distribution channels. They help some Succession and some other things, but they put Chris Weston in charge of that. National Bank has come out of the weeds and decided they're going to be a major player. Everybody is a cash flow lender. So if you're going to build a digital arm, and in that entails usually burning or investing money to get the things going in these startups, nobody is in the mood to lend into that. They lend off of profit, and you need to have positive covenants to take it. But Wawa will lend, Echo will lend, RSA will lend, Intact will lend, Aviva will lend. I don't know that Gore is doing any deals. They bought a couple brokerages. I've seen them do some Succession lending. There's just a couple small mutuals that have some very small deals, but not on scale.
Some of the farm mutuals will do it, and they're good, and they're depending on the deal, but usually it has to be a farm book or something.
Well, you need to have a deep relationship there. Like a stranger's not walking in to treat it like a bank.
No. And BMO is always good. They give you they recognize the asset model.
Let's call them the OG, right? They've been in it forever. They're good at it. Again, cash flow specific, but they understand it. They can move quickly. They have a whole department. that's where National Bank's department came from. I think they are ex-BMO guys that stood that up.
I think everybody has to remember that the level of speed, expertise, and the flavor of the deal is going to depend on what all those finance departments have on their plate at the time. You could largely get ignored if they've got 2 or 3 giants in the hopper and you're talking about $2 million and they're on page 2 dealing with 200 million. It can happen that way.
The business guys are setting the deals. Like, these are happening for business reasons traditionally, whether it's expanding your book or securing a book or rolling a book or distribution like relationship. And then the banker is just making sure it's secure and lending it with good covenants and pieces. That includes like the markets with the really restrictive covenants, and the business person somewhere up the chain decided that a ROFR for 11 years is a really good strategic option to have.
11 years.
It's always 10 plus 1.
That sounds very specific. I think Adam might have some expertise in that particular front, but so that's great. I think we beat this to death. I'm going to wrap this episode up here, but I've got one last question for you guys. My question to you is, what multiple would it take for you to sell your book, for you to sell your business today? Jeff, what's the number?
I'm not going to say at this point. I'm going to go non on the record. Every discussion is unique, so it's very high though. The more you want to stay in the business, the higher the multiple, and the more outrageous the number you come up with. So, but you got to watch it come out with the number. So,
I'll let you think about it. I'll go to Adam, see what his number is, and then if you want to chime back in, you can. Adam, what's your number?
I'd sell for 4 times.
4 times. Wow, that's pretty conservative.
Well, okay. I actually just want to have a lot of conversations, so I'm going to throw it out there.
Adam's number is 4 times. Steve, I think we heard 33 earlier for you, but what's your number?
No, I will give you a real number. 6.38.
6.38. That's a very specific number.
100 trillion million.
6.38.
6.3. Okay, we've heard 4. 6.38. Jeff,
is that the time it is over there? Did you just look at the clock?
Yeah.
No.
It's 6. I got 6 for you.
No.
I'm not gonna comment.
Should I get out my calculator?
No comment.
Yeah.
I'm gonna leave it at no comment.
Okay.
Someone wants to talk about it. That's a separate conversation. How's that?
All right.
Talk to me. Anybody can call it. My number will come up on the screen after it. If it's 7 points or higher. 7 times or higher. Yeah.
Okay.
For a good brokerage, call Steve.
All right, guys. Thanks very much. And as always, pleasure to be with the guys here. Adam Mitchell from Mitchell & Whale, Jeff Roy from Excalibur, and Steve from Cheap Insurance.